For the past 6 months, I've been building one of the largest databases on covered call ETFs and running one of the most comprehensive research studies on them ever. And there's one question I've been obsessed with answering. Which covered call ETF delivers the highest yield without destroying its net asset value? It sounds simple, but the answer might surprise you. Covered call ETFs are rapidly gaining in popularity, with even one fund on this list having over $40 billion in assets under management. These funds deliver massive dividend payments, typically on a monthly and sometimes weekly basis, so it's easy to see why investors searching for yield turn to these instruments. However, there are a lot of bad covered call ETFs out there. Some seem to have perpetually declining share price, and some of them seem to continue to pay out smaller and smaller dividends. It's important we understand why this happens to know how to avoid this potential financial disaster. While investors love to talk about the amount they're being paid in dividends from these covered call ETFs, what they don't talk about is the net asset value, which is quite ironic because over the long term, the net asset value is actually going to determine how much a fund can pay out in dividends. Look at this example. Look at TSLY. The fund was created a few years ago, and we can see net asset value has dropped dramatically during that time period. So what's happened to their dividend payments? What we can see is when they started paying out distributions, it was about $2 per share, but in their most recent payout, it was only 39 cents. That's less than 25% of the original amount they were paying out. So as we can see, a declining net asset value over time can be a potential red flag. To put it quite simply, the fewer assets a covered call ETF has, the lower premiums it can generate, meaning smaller dividend payments. Now, this problem is one of the many reasons I'm building out the Dividendology database. This database currently gives us data on around 65 different covered call ETFs. It links directly to the fund's website. It tells us the manager, the name, the sector that it operates in, the trailing 12 months dividend yield, assets under management. Obviously other important information, but the data that can be very hard to find for many of these funds is options moneyness, portfolio options coverage, and whether or not net asset value has grown since inception. Now, I've touched on why these two are so important in prior videos, but today we want to focus on net asset value. And here's what's so interesting. Despite there being around 65 covered call ETFs on this list, if we filter out all the covered call ETFs that have not grown net asset value since inception, our list shrinks down to just 26. So let's go back to my original question. Which covered call ETF has paid out the most in dividends without net asset value shrinking? And here's the answer. It's BTCI from Neos. BTCI is Neos's Bitcoin high income ETF and has a distribution rate of 28% and pays out dividends on a monthly basis. If we look at the performance of BTCI since its inception, we can see it's up nearly 60% versus the S&P 500, which is up a little bit less than 10%. So we're talking about a wide outperformance. Now, the reason behind this is pretty straightforward. Its underlying holding is Bitcoin, and it has performed extraordinarily well over the last few months. Now, it's important to understand BTCI does not directly hold Bitcoin. Instead, it has exposure to ETPs. Now, what does that mean? Well, a Bitcoin ETP is a financial instrument that allows investors to gain exposure to Bitcoin without actually owning the cryptocurrency itself. So the fact BTCI tracks Bitcoin has given its net asset value a huge boost, but it's important to understand, just because the underlying holding for a covered call ETF increases doesn't mean that the covered call ETF will take part in that upside. For example, if we look at QYLD, a covered call ETF that's been around for a long time, over the last 10 years, its price return is negative 30%. But if we look at its underlying index, QQQ, it's up about 400%. It's pretty clear it does not do a good job in taking part of the upside. But in just a short amount of time, what we've seen from BTCI is it has been able to take part in some of the upside of Bitcoin's run-up. This is obviously a good sign. And in fact, on the BTCI fact sheet, they said this is one of the benefits of owning BTCI. It's the Bitcoin upside potential. In addition to high monthly income, BTCI aims to offer exposure to a portion of Bitcoin's price appreciation in rising markets. If we look at the other benefit, it's high monthly income generation. You probably could have guessed that, but here's where things get a little more interesting. BTCI aims to generate high monthly income through a data-driven call option strategy that harnesses Bitcoin's high levels of price volatility. Now, this is the key right here, price volatility. The amount they generate in premiums isn't solely determined by net asset value. A A lot of it is determined by volatility. When it comes to covered call ETFs, higher volatility means they can generate higher premiums, meaning they pay out higher dividend payments. And this is the real magic behind BTCI. If we look at a 10-year volatility comparison of different asset classes, we can see Bitcoin comes in at about 46.31%. That's a lot more volatile than these other names like Tesla and Nvidia, and in fact, it's about 5 times more volatile than the S&P 500. This allows BTCI to generate significantly larger premiums than most of these other covered call ETFs. If we look at the dividend history for BTCI, it looks like their dividend payouts are typically in the range of about $1.26 per share, all the way up to about $1.57 per share. So when you combine the fact their underlying holding has performed quite well and it's been able to take part in the upside of that growth, combined with the fact that it's holding essentially one of the most volatile assets, you get a huge outperformance. On top of this, a lot of BTCI's distributions are classified as return of capital, which in a lot of cases can actually be a little bit more tax efficient. So while this ETF has clearly been the huge winner, there's still a few risks that we have to understand. To start, the net asset value is tied to a single asset, and that's Bitcoin. Obviously, that's great when Bitcoin climbs, but it's not technically a diversified fund. Now, the risk of that is we don't really know exactly what Bitcoin will do in the future, but compare that to some of these other covered call ETF funds such as QQQI, which tracks the NASDAQ 100, and SPYI, which tracks the S&P 500, we can feel fairly confident that over the long term, those underlying holdings are going to continue to grow. The second risk we do have to understand is simply volatility. Now, while this is an advantage in some sense that it allows them to generate larger premiums, it does also mean that at some point we might see a 30 to 40% drop in Bitcoin. Which brings me to the third risk we have to understand. There's still a lack of data due to the fact that this fund is so young. This fund was just launched back in October of 2024, so it doesn't even have a full year under its belt, and it's definitely had the advantage of Bitcoin seeing a lot of price appreciation during that time. So the question is, what will the performance look like when Bitcoin has a major pullback? What will those distributions look like? So far, BTCI has been the winner of the covered call ETF Olympics, but I will say this is a higher risk, higher reward play. And whether or not you should actually consider this fund heavily depends on what your conviction surrounding Bitcoin looks like. Either way, I'll continue to be building out my covered call ETF database over on Dividendology.com. Link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.